You are welcome to this our enlightenment series again. And the topic of discussion that we have ongoing is on investment. We started with how to start your investment journey with as low as 5K, and we did subsequent videos enlightening you on how you can start, things you need to pay attention to before you start. Today, we are going to talk about risk. Investment is risk. In fact, life generally is risk. So for you to survive in any endeavor, how you manage the risks, the uncertainty that comes with it will determine how you are going to win in that game. You have to understand the basic risk that is going to come with this investment habit you are trying to build. The last time I made a post on my Facebook, I tried to make an opinion poll what held a lot of people from investing. Aside knowing where to invest, the other thing is fear of losing money. Everyone that wanted to invest that don't move or doesn't take a decision, majorly it is due to fear of losing their money, which is the risk involved. Because I know how it feels, even if it is just 1,000 naira that you invested, you lost it at the end of the day. It is going to give you emotional trauma. The fear of losing out is what normally held people back from taking that decision. And at the end of the day, if you don't take decision, you lose more than if you take decision. Because in this game, especially the one we are trying to build ourselves on, we are trying to build a mindset. If you don't attempt, you are not going to learn anything. You will just remain where you are. But when you move an inch, you lose. You know what works and what doesn't work. That drag us to this topic we are giving our enlightenment on today: how you can start your journey and manage your risk along the line. The risk management tactics I'm going to share with you. Remember, this is not about real estate. I'm teaching you on how to build the investment habit using the stock market or financial market, anyone, because the other time I also talk about buying debt. So to manage risk in this journey, number one, how to manage risk, number one, you have to understand what you are investing in. I made a video and I said start building investment habits as low as 5K. I will show you how you can download Affli Investor app 2.0, open an account and start your investment journey. When you have funded your account, what are you going to buy? Do you just go because you see any stock you buy? First of all, understand what you are buying. The simple rule is this: if you cannot explain how a company make money or how or an industry that a company operates, don't invest in them. Because in any business, in any business, there is what drives the cash flow, and that cash flow is where at the end of the day the profit will be generated from. And if you are investing in a company that doesn't make profit, that means you are going to lose. So you have to understand how are they making their money. In this understanding, you can go technical, or you can go in simple way. But remember that we are doing basic enlightenment. You don't need to start reading all the whole finances, but one of the basic financial knowledge you must have is for you to learn how to read balance sheet, income statements. So when you, every public listed company, their balance sheet is being published publicly. So you can download the previous previous audit they publish, look at it and see whether they are making profit or they are not making profit. Maybe with time also, I will also enlighten you on how to read financial statement. So you have to look at their statement, know if they are making profit or not, because if a company is not making profit, there's no way for you in investing in them. So most importantly, number one steps in managing your risk is for you to understand the company, how they make their money, their strength. So look at these figures around them and also ask question. In the game of investment, ignorance is not an excuse, and strategic partnership is also a must. So ask question. People that you know that they are also in this journey of making their money work for them, if you see them, ask them question. Which industry is doing well? Which industry is doing well? How can you evaluate a company to know which company is doing well, which company is not? So very important knowledge, understanding the company that you are trying to invest on. The second thing I also that I also know in how to manage risk is that don't follow hype. In the world generally now, the hype is high. In everything, you see people pay for things to be hyped, and unknowingly to you, when you just see everybody attention going there, you too you will rush. Warren Buffett is one of the renowned stockbroker. If you need knowledge in this investing in stocks, it's one of the successful person you have to consult. And he said one thing. He says that when everybody is rushing to sell, that's when he buy, and when everybody is rushing to buy, that's when he sell. It means that you don't just follow hype. I remember when crypto came early, some people that doesn't have the knowledge of how the crypto works, they just follow the hype, and at the end of the day they feel disappointed. So when you want to become an investor, you don't follow hype, you move with strategy, you move with information. So to manage your risk is, don't follow hype, because everybody is saying, yesterday the stock market, this thing gained by 30%, because of that reason you go and buy. No, you need to work with adequate information. In the game of investment, strategy wins, not hype. So don't follow hype. When the hype is too much, make sure you make your decision based on information and data. Don't make your decision because even me, I tell you this is what is booming now, rush there. You have to have the required information in your hand. You have to see necessary evidence. You have to see track records before you make that investment. Then the next thing is that you diversify. Diversification means that don't put your egg in one basket. If you are coming to capital market generally, I told you there are so many things to buy. You can buy shares, which is stock. You can buy debt, which is bond. Then you can buy fixed assets, which is treasury bills. You can also buy these commercial papers. So if you are in those capital market generally, like now they have free investor 2.0, I told you, they deal with all these ones I called. So another way is that you can, certain percentage of your money, you can put them in stock. Certain percentage of your money, you put them in debt. In the debt, I explained earlier, when it is debt, you borrow a company money for a certain period, the interest is fixed, your money will come back with certain amount. But when it is shares, it is not fixed, the risk is high. So there's tendency for the share to go up, there's tendency for it to come down. So but why you need those in the understanding we talk about in the first place, and not to follow hype, is that there are stocks, the companies that they have shown track record over the years. Like now, you are hearing people talking about the story of Zenith Bank, or up and down. So these people companies, they have shown that capacity. you know that if you are putting your money in this place, the chance of failure is very low. So in diversification, in stock, if it is shares, only shares that you are buying, it also means that you don't buy in one industry, you spread your money across different industries. Like now you can buy some company shares that are doing well in oil industry. You can buy in consumer goods like Dangote sugar, Boa, those companies that deals with consumer goods. You can also put some in telecommunication like MTN, Airtel. Then you can also look at AI listed. Now that the hype is all around AI, or the attention is going towards AI, or even transport. The idea here is that don't remain in one industry, so that when the industry is crashing, all your money should not crash, your eggs should not be in one basket. You can also put some in real estate. In in technical terms, they call them asset allocation, meaning putting your money in different classes of asset. Even physically, in the physical world, when this series become very technical, we'll be talking about even the area I major most, which is real estate. In the real world, you use also diversification strategy to spread your physical assets. So diversification is very important. It's key in managing your risk. It's key. So you don't have to buy. When you hear people call portfolio, it means that they have categories of different companies on different industries that they buy their shares. Sometimes when a share of certain industry go up, some go down, but at the end of the day, you still remain stable. Or even if when you do the plus and minus, you see that you are still having your capital appreciation. So you have to diversify. I don't know how well I can explain this diversification for the basic, most of you that are just starting to understand what I mean. I use industry to explain, and I called some companies in those industry that you can look. I'm calling them doesn't mean that I say you must go and buy. As I said in the first one, don't follow hype. You must go and look at their track records. How are they doing over time? But the knowledge here is that you must diversify, and there are some percentage you can do. Those theoretical percentage, I may not advise you. Sometimes you share them based on how it suits you. So I said you can diversify in bond and stock. You can also be in stock and spread across various industry. Then the next one, very important, you must understand your risk tolerance level. Risk tolerance level is how extent you can absorb, let me say, failure without putting your own life into challenges. You see, there are some people that their risk tolerance is low. It means that they cannot absorb any shock. If anything happens to them, it might lead to another thing. So these people are not advised to put more of their money in stock, because that one is going up and coming down. It is bond that suit them, or fixed assets. So you need to know how comfortable are you in taking risk. The last time somebody chatted me, and what suit me most is that the person understands his risk tolerance already, and told me that I'm a high risk taker. That's what the person said. It means that even if you put money in stock and the money goes down, it is not going to is not going to cause him harm. And some people, they can even immediately they see that something go down, their heart can develop a shock that can lead to another health issue. So know at the level of risk you can take. In the previous video where I talk about the 5 things you need to know before investing, I told you that you shouldn't take money that you need instantly and you take them and go and invest them. You should know that any money you are going to involve in investment, this type of investments that will be a threat to your survival, don't go and invest them. Because first of all, your health first, your well-being first, then you invest what is left. It's not that you are not you haven't settle your basic needs, you carry money and invest. So any small thing that happens, it now cause you depression that can lead to another health challenges. So understand your risk tolerance level. If you are a high risk taker, it means even if something, if anything happens to your money, you can absorb it and know that you said that is how life is and still move ahead. But before you can be able to absorb such kind of shocks, it depends on how confident you are, both financially and otherwise. So you must manage your risk tolerance level. Very, very important. Then the next one is, we're talking about managing risk. Don't move with emotion, move with strategy. Indirectly, I said this where I talk about understanding. Investment is not an emotional game; it is a strategic game. Emotion in the sense that because you fall in love with something, that was why you are going to invest in them. It will not work that way. I used to tell people that if I'm playing football bet, I'm going to lose all the time, because as an Arsenal fan, even if Arsenal is losing 5-0, I will still believe that they are coming to win the opponent. So with that, I'm emotionally attached to that club, and going to stake bet for them, it means that already my judgment is already biased, so I'm going to lose. So you don't move with emotion. If you want to manage your risk, don't move with emotion. Emotion can come in falling in love with a particular company that you know. For that reason, when you want to buy investment, that is they are the one you are going to invest with. Emotion can also come due to the hype I talk about in the first place, because other people are investing in certain things. That is why you go and invest there. So you must make sure that every decision you are going to make should be based on strategy, based on information, based on understanding. Emotion zero. It's not a game of emotion, it is a game of strategy and understanding. The next thing is, you need to learn how to manage your expectation. Not Sometimes it's not just the money, your capital that you are managing. You also need to learn how to manage your expectation. The experience I know about people that invest in some of this capital market is that every day they will go and be opening the app and check whether their money is going up or down. So it will raise your temperament. No, manage your expectation. Don't put money now, tomorrow you are expecting magic. I also talk about this previously. So you must learn how to manage your expectations so that your mind can be at ease. Finally, now, for those of us that are just starting, I start small, learn fast, and invest more. Start small, learn fast, and invest more. So the concept of learning, I haven't stopped telling you about learning. So if you want to be better off in investment journey, if your aspiration is high, you are looking at making something big, learning is not an option. You have to learn. It's not an option. So, and you start small, using that small that you are starting with to garner experience, to garner capacity, so that when you made up your mind to put in big money, you know how to manage them. This is how to basically manage risk by playing in capital market. On the final note, know that investment is not gambling, it is a structured decision making. And every pro investor you know today, they were once a learner. So your journey to start being a pro investor start from the very spot you are now. The best decision you can make to yourself is to start and not to wait. So thank you very much for also listening again. I don't know wherever you are watching from, but in any platform you are watching, don't forget to either follow up or subscribe if it is YouTube channel, and most importantly, share so that people that need this information can get to know about them. What are we going to talk about next on this our enlightenment series? You can help us with it. Thank you. Until we see again.